So it's my pleasure to introduce Brady Reicks. Brady grew up on a row crop and hog farm in northeast Iowa, a proud Cyclone. He attended Iowa State University from 03 to 08 and graduated with a double major in management and marketing from the College of Business, not agriculture. Following school, he spent 18 months at Wells Fargo Home Mortgage, then spent 5 years working for Kearns & Associates, now part of EverAg, as a broker and consultant. The last 10 years, he has been an owner-operator in his family business. Brady spends most of his time working with live production decisions and essentially managing margin. This includes hedging, purchasing feed ingredients, managing nutrition, and marketing hogs. Please welcome Brady Reicks to talk about some risk management perspectives.
Can everybody hear me good? Thanks for the intro. Yeah, I was a little bit of a rebel when I was younger, so I went to the College of Business and not the College of Agriculture. So I did notice, I have to say, I looked at the 4 speakers for the morning here. 2 were doctors and 1 was a command sergeant major. So, and my title's producer. So prepare accordingly is my point. Am I missing the clicker? There it is. So quickly about me, the intro did a good job, but I'm married, I have 3 kids. I'm not thinking about pigs, I like watching sports. One of my bigger roles is the assistant to the general manager of our family, the general manager, of course, being my wife. One of my major non-work commitments today is youth sports volunteer assistant coach. It's a long title, it's not a paid position. Actually costs quite a bit of money, as many of you know. I am a 6th generation pork producer, proud pork producer. We're based in northeast Iowa. We have about 70,000 sows fair to finish. And my dad and sister and I operate the business. As was covered, I'm a Cyclone. When I graduated, I worked for Wells Fargo Home Mortgage. That was when many homes were in default. I worked in the default department. It was the kind of best job I could get at the time. And then I met Joe Kearns around the 2010 period, and earlier in my college years, I interned with MPPC in Washington, D.C. as an international trade intern. That got me interested in commodity markets. And through meeting Joe, he was kind of starting up his own thing, and so I worked with him for 4 to 5 years and learned a lot from him. And since then, I moved home and fighting the good fight, right? What I want to try to do is kind of define risk management as I see it, and kind of make some similarities between, just your risks of running a production company or just being in any position. Anybody in this room in the industry manages risks, and then what I call margin management, and kind of talk about those two. I'm going to talk a little bit about the market and what I think is going to happen. That's not really my job. I don't think today. You've got people in the afternoon, I think I noticed, that can predict markets better than me. I pay people to help me with that, so I don't do that anymore. And then I'm going to go back and turn back time and look at the past and some things that I've gone through in my career and things I've learned in the realm of margin management. So I'll go over here. I did the Webster's, or today Google AI definition is risk management is the process of identifying, assessing, and controlling threats to an organization's capital and earnings. Then kind of here to the right, you've got kind of a traditional model, right, where you identify risk, you assess the risk, you create a plan, you manage the plan, monitor it. I think that's useful, and I spent a lot of time early in my career trying to think about that. I think what's easy to lose in that process is what is success? What is your destination? What do you want out of your risk management plan? And that could be different for everybody. That'll be a theme as I talk. So the way that I think about it is that picture right there, right? What is success, in terms of, your business? How much money do you want to make? What do you want the future of your business to be? It changes and flexes, but you should know what it is, right? It'll change, but you should know what it is, especially when you make that decision. That should be the guiding light versus maybe that image earlier. Then just me, how I think about it day to day. I think managing risk is situational, it's dynamic, and in terms of like the market, right, commodity markets, there's a lot of noise. I think it's good to listen to the noise, but there's a lot of it, right? Social media, the internet, it just changed how much, even since my career started, it's so much easier to get information, cheaper, it's more accessible. So I think you got to get really good at filtering it. That's how I think about it. And so that, that's another way of saying it's a combination of facts and feel. So now that we've kind of defined risk management, let's talk about it more broader industry, right? Not commodity markets. So obviously today, I think front and center is disease, right? It has been for years, but right now, I think we're kind of in the on again in terms of disease presence in the industry. So how everyone deals with that could be different depending where they're at, depending what they believe, how they believe per spreads, right? How they believe they can stop it. Then management, generational transfer. I'm right in the middle of this right now, right? So there's a risk that the generation that built this industry and grew it rapidly, that millennials like me will pee it down my leg, right? So you have to, that is a risk you have to assess. I think everyone in this room is probably assessing. And this was kind of referenced earlier, I think, by Dr. Matt, but just the skills and experience that we have, those people in the industry, to continue to grow it and make it successful and make us competitive. So those are all swine industry risks. Then there's that kind of the traditional input cost, feed ingredients, grain quality, grind mix to liver, how much feed cost, vaccine, medications. These are all risks that we deal with daily. Revenue. Since I've been involved in the industry, how do we determine what a pig's worth? I think it's still an issue. It's something we strive to get better at. Target weights, percent sold in primary market. These are all risks that people in the industry need to manage. So after I think about that, I try to think of common themes. And I think the common theme of all those risks is they're changing a lot, super volatile. And like what you focus on every day, the top of the priority list, I think a lot in priorities. Okay, what are the top 5 today? What the number 1 can change a lot, right? So you need to, that's part of being a producer. And maybe most importantly for my message today, takeaway is the way to manage each of these risks is probably different for each person, right? So it's not a one-size-fits-all process. Oops, I skipped. So now we'll move on and kind of dive into a subset of risk management, I would say, which is margin management, which is probably what I'm here today supposed to be talking about. Going to use old Google AI again. Margin management is the process of monitoring, analyzing, and optimizing the difference between a company's revenue and cost to maximize profitability. Pretty straightforward, right? I think one thing I think about is you could argue that everything you do every day is that, right? Any of us do in our roles. But for this exercise, I'm defining managing margin as cost is feed and revenue is a market hog. And feed is corn, soybean meal, and the other ingredients that you feed a pig usually kind of correlate with corn and soybean meal, right? And then what's our tool to manage that risk? Well, whether it's insurance or futures or options or swaps, it's all kind of comes back to corn futures, soybean meal futures, and lean hog futures that are traded on the CME. So now that I've defined it, what are the risks? No different than the broader industry risks, right? You've got your traditional supply and demand fundamentals, right? So corn crops in the field right now, how many acres did we plant? What's it going to yield? How much of it will be harvested? Demand, feed, ethanol exports. I think feed is how corn was intended to be used, but that's a joke. Sorry, corn growers. I love you. And then on the hog side, supply and demand as well, right? We're going to have a hogs and pigs report today. How many sows are there? How many pigs per litter? Maybe a new one. Wean to finish mortality, maybe a bigger wild card the last 3 or 4 years that is hard to pinpoint, right? Or get a feel for. And then the demand side, how much pork are we selling? How much are we selling overseas? what's the price of chicken? What's the price of beef? Those are all risks you got juggling in your head. So the point I'm trying to make is this is the same as the previous slide. It's the same thing as managing your business, right? It's volatile, changes all the time. What exactly you should focus on today changes often and quickly. And the way to manage each of these risks is likely different for each producer. It's probably different for me as a 40-year-old man and my dad as a 68-year-old man, right? How he thinks about it. Or somebody whose balance sheet is really strong or isn't as strong. Or somebody who just might not be as risk tolerant as the other guy, right? So I think that's what I've learned mostly over the years is it's different for each person, and you gotta take the time to figure that out. Okay, so I'll do my obligatory market stuff, right? So I have to figure out how this works. So if you look at slaughter, the blue is this year, and then everything else is either the past 2 years or a 5-year average. And start the year, we probably are on the lower end, then kind of caught up. I mean, nothing really jumps out at you there. In my mind, there's definitely not more pigs slaughtered on a weekly basis. Weights, I think because there's been some margin in the business, people have raised weights. That helps counteract some of the slaughter shortfall. But at the same time, I'm not sure why I have this on a supply slide, but I guess it does reflect supply. Look at the price of pigs, right? Recently gone up sharply. The price of weaned pigs, right, is very counter-seasonal going up. So obviously something's going on, right? I think it's that disease issues that we've had maybe in certain areas really concentrated in one spot. So while supply seemingly isn't that dramatic, something's forcing the market to be higher than it normally is. So maybe there is some concentrated supply holes, right? That's what we'd probably term it. As far as demand goes, same kind of thing here. If you're following along, you've got that navy line that's going up quickly. That's the cutout, right? That's pork, the price of pork cuts. And that is, going up quickly, earlier than it normally does. The why, I think some of it has to do with the supply holes we were talking about. I think some of it has to do with we're selling more pork domestically. I think it's priced competitively. I know we all think it should. It looks pretty cheap relative to beef, especially, right? So I mean, as far as what I think will happen, I think that'll maintain. I would say that's starting to get, just common sense. That's kind of high, right? I don't know if there's a big flashing light that says it should go higher, right? Or that there's a reason that would make it go even higher. But I think it can maintain. And of course, we've had Liberation Day and tariff fun. And so that's kind of hurt the exports here. That's the orange line is 25 exports, right? So it's kind of rebounded here recently, but that's, I would call that one maybe thing when things normalize, maybe supply normalizes, demand normalizes, domestic demand. The export problem could be an unforeseen drag on the market. So yeah, this is a little bit busy. I'll try to take a little bit of time here. So this to the right here is kind of a scatter plot. So it shows what the stocks to use ratio, which is basically how much corn is left over versus how much is used. And that's kind of on the bottom axis. The vertical axis is price. So it tries to, this line should tell you, okay, if the stocks to use ratio is here, this is what corn should be worth, right? Right now, or last year, we kind of had right on. Maybe right now we're carrying a little bit of risk premium in it. I think that kind of would probably sound odd to some people in this room. It feels like corn's too low. That's probably because the year before, this is kind of, the stocks to use ratio. Another way to look at it is the ending stocks. So it was 1.7 and the farm price was 455, and we have not that much more this year. If we have a crop, it's at 420. So I think maybe if you had 23, that might be up here, right, on the scatter plot, if that makes sense. So But to be honest, this is kind of boring to me. I mean, I think there is risk, right? If there's a weather issue, the stocks are tight enough here that the market could rally 50 cents or so, somewhere in there. But I think if we keep getting rain, I think this will kind of be, it should say steady within the range it's in. And then for my job, this is what really matters, right? What is it all? What's available to you in terms of margin? Just back to our previous slide, cost minus revenue, very simple. And here what you have is this is kind of a bell curve of historically what these months, give you, the return that you can earn using a formula. And the orange line is where we are today, right? And the higher you go, that's making more money, right? So here, short term, it's much higher than historical, right? It says you should probably do something about that, right? And I have. Here, less of a, clear above history, but it's still clearly above history. And up here you can kind of see the raw numbers, right? Where the average margin is, where the currently is. So I guess, back to kind of my theme, this is an opportunity. This is a situation you can take advantage of. And then when you do, how do you do it, right? I think that's the message I'm trying to give. So I think I am zipping through this. I think I am, but that's okay. Gonna go back in time with share here. And I had 22 on here. I don't actually have an example for that. I didn't get that done. But my goal here will be just to kind of talk about history. You think about all the things that I just talked about and how those are rolling around in your head. And then go back in the previous future, think about what was going on in your head. What decision did you make? And how maybe could you learn from that, right? That's what we're all trying to do every day, I think. So back to 2008, when I was in the cubicle at Jordan Creek, I wasn't a producer at the time, but I remember my dad going through this. So you had, ethanol, the whole ethanol thing was starting, right? And so you had $8 corn, and you had $78 hogs. Not a great proposition, but probably a little different break evens today. Probably our non-feed cost is lower than, and so the break even in your head might be different there for what it is today. But then in September, I believe, was Black Monday, is what I remember, and the stock market crashed and Bear Stearns went bankrupt and all that jazz. And before you know it, in a few short months, corn is $3 a bushel and hogs are $50 a hundredweight. So, that happened. And so if I look back at that, what do I think about what I could learn from that? I think when you think about that margin, often you are tempted because you feel one side of the equation is the right, could go up. Like in this occasion, you could say, oh, hogs are gonna go up. So I will not hedge hogs. I will not sell hogs, but I will buy corn at 8 bushels. Well, that obviously would have been a problem, right? If you would have been, it would have been good to have those hogs sold at $7, right? But you'd be paying through the nose on your position here, right down to $3. And I might know somebody who's related to me that was in that position. So I think, what do you learn? I don't know that you learn any one thing. I think that there's risk in leaving one side open. That's why you manage margin. And that's what can happen. And kind of an unforeseen thing. I mean, I know there was probably economic signs at the time that the economy wasn't going to be good, but I doubt many people saw what happening, right? There was a movie about that called The Big Short. So next scenario, next experience is PDV. I remember this very well. I learned about this when I was at my sister's graduation party when she graduated from high school. And it was announced, I think it was May of 13, that PDV had entered the United States. So don't need to go through all the specifics of the disease, right? But what happened to the market? So at this point in time, when this all happened, this was your opportunity here, right? Probably not a lot of profit in there, but probably a little bit. And probably not a scenario in which you would say, even with this, I think I remember actually when the news came out, the market went down for a little bit. I think it just took time to process what it meant. And So that might not be a bad time to sell. And if you were going to go look at, that historical thing I showed you in the past, that's historically very high at the time, right? Like that's about the top. So, well, what happened? We didn't repeat history, right? Hogs actually got up to 130. I think they averaged in this quarter 115. Corn actually went down. So that happened. So what can you learn? I think this would be an example of, take time to understand where the market could go. Think big. It's kind of like Dr. Matt Culbertson talking about his production possibilities, right? If you did that, which I did kind of pick years where I think we kind of were right, to be honest, and we kind of left the upside open that year, and I'm glad we did. And part of it, what we did is we were like, well, if there's X percent less, and where could the market go? And we did use, I think it was at the time 2.7, 1% less supply was 2.7 more, 2.7% increase in price. And so kind of came up with like 120, 130 as maybe a place to go. Well, that's where it went, right? So if you hadn't had that, took the time to dream a little bit and be flexible, you might not have been able to take advantage of that, right? And I think the other thing is there's ways to build these positions so that you can have a floor and a ceiling, right? Won't go into all the details of all that, but I think what I learned is that's worthwhile. There's value in that. All right. Situation 2, African swine fever in China. I think, this is a situation where I think we had sort of had the really great run 2 or 3 years before that, and then it kind of leveled off, right? Might even been some negative margin. I should have put up the margin, the Iowa State margin calculator. But corn was very affordable at the time, real quick. So this happened in September of 2018, right? I'm using April of 19 to illustrate this. So by the time we had gotten here, I think it was pretty well known how devastating the disease was. You're starting to understand how much pork they would need to replace what they lost, right? That was the conversation at the time. So therefore, the market went to $97 in April. So just remember, this is April of 19. These are the same contracts up here. So 2 months later, it was down to 80. And the corn market went up to 440. So within 2 months, what you thought, and these are July contracts, right? So that's when they expire. So what you thought was going to happen changed dramatically, right? And I think, so another variable, like right now might be a good example, right? I don't think anybody in the world thinks the market's going to really go down much in the next 6 months. I think what really happened here is the Chinese figured out how to eat things other than pork. I think that's what happened. We didn't know that they would do that. But what can we learn? Sometimes the window is tight. A bird in the hand is better than 2 in the bush. And kind of the opposite of the previous. ASF wasn't PED, right? I remember having conversations, well, why just 97? Just a few years ago, it went to 115 or 130, right? Well, it didn't. So there's my kind of, I guess, history lesson. So conclusions, it's philosophical babble here. I think the biggest thing I learned, when I first started to get into this, like markets, Wall Street, Chicago, New York, these people must have this great vision and they know all these things that nobody else knows. Well, all that's somewhat true, and it's about relationships, and there is no magic, right? Nobody knows what's going to happen in the future. And so don't think you got it figured out ever, right? It's good to have an opinion, but don't think you ever have it figured out. There is no magic. That sticks with me to this day, almost every day. The way that the CME is structured, there's opportunities, right? That's what I just tried to outline there. At the end of the day, what are you going to do when they present themselves? And what is success, right? And so kind of to share with this group of people, it's just like managing the business that you manage every day, or the farm that you manage, or the customer base that you manage. Have a plan, but be ready to change the plan if needed. I think I'm going to get done a little early here, which is okay with me. I would say to put a bow on it, risk management is about process, but you don't want to forget about the destination on the way. I think that's what can happen in those two scenarios is what do I want? What is the goal of my business? To build my business, to preserve capital, to grow, to diversify? What is the goal? Let that be the first thing you think about when you're making that decision. Well, what if it goes to 130 or, oh, I didn't hit the top or, oh, I didn't buy at the bottom, you know. That's a way of not remembering the destination. In terms of today, we're in a good spot, right? So I'm just repeating myself. What's your situation? What goals do you want to achieve, and how do you want to apply to your strategy, right? I just put this on here to, things that I'm thinking through, right? Well, if you have, some really bad wean to finish mortality, maybe the margin you think you have there isn't as much as you think it is. Or if your sow farms are breaking with PRRS and your wean pig cost is, or you buy wean pigs on a contract and it's, it's higher than it ever has been, that changes that. You got to be thinking about that. Maybe where's your balance sheet at? There's been some tough times, right? Yeah, you could make more, but how do you want to set yourself up for the next 10 years? And what is, where are you at? Maybe some people are setting up their business to sell, maybe in our situation, how do we transfer the business to the next generation? And then lastly, I think, take the time to review the risk management decisions you've made, evaluate them, and it's not a game of perfect, right? There isn't. You can't, it's literally impossible to buy everything at the bottom and sell everything at the top. So I think that's another way to get out of the flow and get away from what your destination or what success is. So have a plan, but be prepared to change it. And I'm glad the previous speakers talked about this. When I really think about my career in managing risk, it's really been about people. I've met people that have my best interest at heart, my family's best interest at heart, and they want to see me succeed. And if you surround yourself with people like that, you'll be all right, right? They won't always know what's going to happen, but they'll be looking out for you. And if you have those people that really care and want to see you succeed, you'll be fine. And I'm using Matt Campbell as my voice of those words. So with that, eat more ham and bacon, and I'll take questions.
Thank you, Brady. We'll take questions. I got the first one right here in the front center. I'll get you a microphone. That big spike in demand you saw rise in price, it's demand. Pat's went ahead and purchased all the Iowa pork tent product coming up. That's done, and that drove it up. We had Pork Expo. We have Iowa Swine Day. We have other states. It's all pushing.
Should do that more often.
Okay, I agree. Go ahead.
Thanks, Brady. Yeah, anybody who's done risk management knows it's emotionally tasking. You sell, hogs on the futures, and then the market goes up, and you kick yourself, and it's always interesting. But do you have objective ways that you measure your performance when it comes to risk management? Do you have any sort of scorecard that you are building a history and saying, what was my range and where did I perform within that range?
I think we have a financial projection that we give to the bank at the beginning of the year. I try to measure against that. I push to, when we meet that objective, do something to protect that. That'd be one way. Another way, a little bit more complex, is I just like to simply have the life of the contract, what the high and the low was, and then the average to where you bought if you're buying something, or where you sold if you're selling something. So throughout the history of that, where did you, that wouldn't be margin. That takes it a step further, so at least challenging yourself to say, am I paying attention? Where did I buy, where did I sell? But to be honest, to me, it should be what did I plan for this year? What was my financial projection, and did I meet that? If I go above it, awesome. But I don't know if I answered your question.
Other questions? I have a follow-up one to that, actually, is related to managing margin, which is about projecting some profitability. Get to year in quarter three. Is it helpful from a tax management standpoint? which, unless you're a diversified investment portfolio outside of pork, where do you go with things?
Managing taxes.
Managing taxes.
Well,
or debt restructuring, right, and paying down debt.
Yeah, I think, I would say that any farmer I've ever met it's ingrained in them to not pay very many taxes.
Exactly.
So I think that's the first objective usually that your accountant talks about. But yeah, I think it depends on the situation, is would be how I would talk about it. But yeah, honestly, I mean, to not directly answer your question, but go off on a little tangent based on that. I think that's why our industry grows, is because people make money. And the best tax advantageous way to deal with that is to build more or invest in more. So that's another difficult decision to make. Maybe I need to just pay taxes and not grow, because maybe there's enough ham and bacon to be had. And if we're gonna have, what's it, 45 PSY? Mm-hmm. So that is a real conversation, right? And we just came off of a couple bad years. Now times are good. What do you do? Right? That's all. To me, that's all part of the process I just outlined. Where do you want to go? What is it that you want to do? What are your goals? Taxes included.
Up front here on the side.
Thank you. Can you talk about livestock revenue protection and how that's changed, what you've done over the last few years?
It's changed a lot, ton. I don't know what I'm supposed to say and not say, but it's just a subsidized put in my world. So and not just that, it also is. It doesn't require money up front, right? So it makes it a lot easier to pull the trigger, right? And then I would comment that last year the hog market, the summer markets didn't really ever perform, so they were like in the hundreds, and then when you got there, it was actually more in the 90s. I know from a lot of people, they put the livestock risk protection in place. The market went down, and I mean, there's ways you can capitalize that with futures and options, but it's harder to. My point is, you can't get out of it, right? If you're selling futures and the market goes from 190, you can get out. Well, a lot of people never got out. That you couldn't get out if you're LRP. The people that didn't have LRP and had the traditional tools, they got out, and it never went back up. It went back down. So that's kind of a benefit that you can't, quote, get out of it or exit it early. But I think it's changed. I think it's changed for the good, for the most part, right? I think it just makes it's just another tool in the toolbox, and it can kind of be. Just gives you, it's another tool in the toolbox is how I'll end it. I think it's been a good thing, and I know there's kind of been some changes made to it, or they're talking about making sure that it's not used improperly, but I think it's a good tool. I hope we keep it.
Other questions for Brady? No, sorry.
Brady, there's a number of people in this room that don't own pigs and aren't exposed to that part of the risk that you've just described. How would you recommend what are the takeaways you'd recommend that they have when they're interacting with people like you who are exposed to those risks?
It's a really good question, Gene. Gene asks good questions. I know this. Yeah, I think it's probably the last part that we just looked at, where things happen suddenly that really drastically change your plans, what you're thinking, where you're headed, what you thought was your plan for next year a year ago. It can change like that. I think, it's more than just numbers dancing on the screen, right? It's your livelihood every day. So I think that's probably the biggest take home is it's driving everything, or it should. I think you need to pay attention to it. I believe there's a thought process out there that you just let it all happen, right? You don't hedge anything and the market will take care of it, but it's not how I was trained. So, I think it's about understanding the vastness of it and how it impacts your day to day.
Okay, one up above. Yep. If there's any others, get your hand up. We'll take one more final one after this if we have it.
Thank you. What percentage of your time any given week do you spend thinking about these things?
That's the best question yet. Increasingly less as I get more involved, right, and have more responsibility. But I'd still say my goal is every day to talk to someone on the phone for at least half hour about these things. Sometimes we don't end up talking about markets, but I try to. And just be aware, right? So it varies. When I was younger, it's all I did. Now that I'm more involved, it's less what I do. I'm trying to figure out how to do that. We're trying to figure out how to do that as a business. But I think, not your exact question, I think the most important thing is to always have an opinion. If you got some stuff in the game there, you should have an opinion on what it's going to do. And that should be enough. That should keep you accountable for your time commitment.
Any final ones? Let's thank Brady for his time.